Hi, it's Mike Lynch with AmeriFirst Financial, and it's time for your Monday morning mortgage update for the week of April the 26th. Hope everybody had a great weekend. Gosh, it was a cold weekend. The sun came out, the rain came. It was just kind of a mix. It either wanted you to stay inside and eat a pizza and watch movies, or get outside and really enjoy probably the last cool, cold weekend that we're going to have for a while. Hope all of you had a wonderful weekend. So let's talk about the market. Last week, we actually saw rates end the week the same way they started. Not much movement. A lot of economic reports came out, but just a really flat week. So we started last week locking, and then we moved into a floating position, and we just didn't see much of a change. So let's look at this week. What are the three things that we're looking at? We're looking at Fed taper, economic reports, and the kitchen sink. So Fed taper, the few central banks have some their meetings this week, Bank of Japan and our own Federal Reserve. And our own Federal Reserve, well, first of all, we don't expect anybody to make any big changes to policy, but our own Federal Reserve is going to come out with their interest rate statement this week. And that could have some impact on the pricing. And really what we're looking for is, what is their policy moving forward, and when are they going to start tapering the buying of mortgage-backed securities in the bond market? They've been talking about knowing they're going to have to taper eventually, but when are they going to do it? Third quarter, fourth quarter this year, maybe into 2022. Now, are they going to announce when they're going to start that taper? We don't know, but we're going to be watching this. And what that really means is, if they start to taper, meaning buying less mortgage-backed securities in the bond market, that could have an impact. It will have an impact on rates. It'll drive the rates up. Now, what could offset that is open market economic activity, in which we start to see investments in the bond market. And so the Fed's trying to balance this. They want to taper buying less of those mortgage-backed securities, which they've been doing in millions and millions of dollars since COVID started, to keep those rates low. This is why we have such great mortgage rates, is because the Fed has been dumping money into the bond market for months. But they want to balance this out and start to buy less, let the market take over, so that there's a normal market activity that impacts those mortgage rates. So again, what will they say? We don't know, but we're going to be watching the reports that are coming out with the Federal Reserve meeting this week. Second thing is economic reports. So there's a lot of economic reports coming out starting Wednesday, Thursday, and Friday. Consumer confidence, how good people feel about the economy. Housing appreciation data, are homes going up in value? We don't expect any change there. Yes, they're going up in value, but are they going up at the same rate? And then personal income spending, consumption, and how they're spending the money and the income they're receiving. So if we have increase in consumer confidence, that means that people are going to spend more money. Good to the economy, bad for mortgage rates. Appreciation, we don't expect much change. Personal income, personal spending, and personal consumption. If we see that as a society in the United States, that we're all making more money, we're all spending more money, we're all consuming more stuff, that's good for the economy, and that's bad for mortgage rates. So again, we'll be watching those numbers and those reports this week. And then the third thing is the kitchen sink, kind of a modge podge of a bunch of stuff that's coming out that has an impact on mortgage rates. Number one is COVID, that hasn't gone away. It's spreading around the world. That's interrupting supply chains, has the potential to interrupt supply chains. We're a global economy. A lot of the stuff that we buy comes from other countries, or parts of what we buy comes from other countries. And so if those supply chains are interrupted, then that's going to affect the amount of stuff we can buy. And if the demand's up and the supply is down, then that drives up prices, drives up inflation, and that could actually mean rates go up. Biden, he's addressing Congress this week, and he's really going to talk about two important things that could affect mortgage rates: tax policy and infrastructure spending. So an increase to taxes, and I think everybody can agree that's probably coming. He's announced that it's probably going to be something that they promote: increased capital gains tax, increased corporate tax. Taxes going up, that could have a negative impact on the economy. It has the potential to do that. At least that's what the bond market and the bond traders look at. And then infrastructure spending. Everybody's talking about this second infrastructure bill, multi-billion, trillion-dollar infrastructure bill. But really, what does this look like? A lot of people are saying that this infrastructure bill Parts of it are going to go to infrastructure. The rest of it's just going to go into the pockets of politicians and their projects, and it really isn't going to be all in infrastructure. So a lot of attention will be paid to that. How will the bond market react? We're going to pay attention to that. And then the third thing is rents. A report came out over the weekend that rents are going back up. They stayed flat during the COVID of last year, but they're actually going back up in metro areas and actually increasing in rural areas as well. So how is this going to affect our economy? How is it going to affect people's buying and spending habits if they're paying more to live in a place? So we'll be watching that report as well and seeing how the bond market will react to that. So we got a heavy economic week this week, really starting midweek towards the end. A lot of volatility mid to the end of the week. We're going to start the week floating with real cautiously floating and a lot of flexibility to lock in those rates if we start to see the market worse. So if you or your clients need any insight about mortgage rates, interest rates, give me a call. All my information is down below. If you know somebody that can benefit from this video, please forward it to them. And if you have any comments about today's video, I'd love to hear them. Have a productive week, and we'll talk to you soon. Bye-bye.